Welcome back to video number 25 in our series of quick strike videos for the month of February. Today we are going to cover Analysis Tools Expected Range tool. Before we get started, let's just review where we land when we log into quick strike for the first time. Again, we're on the market dashboard product overview. This is for the 10-year, and we can set our favorite product group and favorite product in the My Account Preferences section, right? So we're getting our bearings of where we are when we start. So let's jump right in and take a look at the expected range tool. So let's just go over the page in general like we usually do. So we have our expirations that we can choose to view over here and underneath the expiration section, as well as the weekly expirations in the case for the treasuries. We have clickable symbols in the title bar, so this will bring up the expiration pop-up as well as the futures pop-up, and then we have some details very specific to the treasuries where we're showing the yield that's currently for the future that's tied to this expiration, as well as the DVO1 for that same future, given the most recent cheapest to deliver information that we have, which as of right now is probably from yesterday's close, because we don't start processing that stuff until after settlements take place for today's trading day, and we're still sort of in the midst of today's trading day for the 25th. You'll notice we have our analysis bar here, typical settings for the future vol and the days to expiration. We also have our button with an icon next to it, or our text with an icon next to it, which makes this a button that we can click, and we'll talk about that a little bit later when we get into more details about what's happening on this page. And we have our reset arrow here as well. To the left, we have the different views that we can have within this chart. And we'll cover each of these in detail today. But we have a volume section and an open interest section. As we click on these different tabs, we'll explain how that information is presented on the screen. So first off, let's just give a very general overview of what this thing is supposed to do. So really what we wanted to try to do is give a face to volatility and present it in a way that you can see it as opposed to just sort of hear a number and then have to look at that number in a line chart to see where it is historically or where it compares to other volatilities. In this case, what we're trying to show you is how this volatility ties into the actual expiration that's associated with it. In this case, we're looking at the April Treasury contract, which has a current at-the-money volatility of 5.5. So what are we displaying here on this chart? So basically what we've done is we have a futures price that's currently about 130.28.5. Okay, so that's what we see for our current. Here's our settlement price, this dash line, and then here's our current futures price. Okay, so this chart is going to be centered around our current futures price. So here we see, if we hover over this, we have 128.5 and then 130.28.5 and 130.20. So 130.20 is where we started. 130.28.5 is where we are right now with the solid line. So our statistics are going to be around this center point, which is the current underlying futures price. Okay, so what we've done is we've taken a current volatility of 5.5%. This is an annual volatility, and we have a current days to expiration of almost 28 days. So what we've displayed here is that given the current volatility of 5.5% and the current number of days left in expiration, we're showing 1 standard deviation, 2 standard deviation, and 3 standard deviation range given this volatility. So the idea behind this is for you to be able to see what sort of strike range is encompassed by the current volatility level. Now we've opened up these cells as well, so you can play with it. So you can make the volatility lower, decrease the number of days, or change the futures price, and it will redraw the chart around those new parameters. But as far as it's concerned from what it looks like in this current chart, and we're going to just leave it right now for the current values, we're saying that centered around this 130.28.5 underlying price, we have here this first shaded area is 1 standard deviation, the second shaded area is 2 standard deviations, and this third is 3 standard deviations. So what we're really trying to do is showing you, hey, how much is 1 standard deviation? What is that going to cover from a strike standpoint? What's 2 going to cover? So as things start to trade, you could say, well, that's really way out there, or that's right where it should be. So there's an expectation that that strike might come into play. So that's the idea behind this, and that's why we show you in both numerically, so you can see what your range is going to be from a, what the expected range, that's the name of the tool, given this volatility is going to be, and it's in tick terms here that you see here in the numbers in the pipes, and then also standard deviations as you see in the shade. Now, the bars that you're seeing right now are volume bars, but for the intraday volume. So these are actual volume numbers of what occurred today. Okay, and you can click on these and get some details about this particular strike and open interest in the volume. So this is showing intraday electronic volume for today's trading day. So we see that a lot of activity took place within a single standard deviation, but then we had some in the second standard deviation, and we even had some way out here in the third standard deviation. There was some call, purchasing, selling, obviously both going on because it had to happen for one had to happen for the other to happen. So we had a pretty nice pocket of volume here out in the way in the third standard deviation. So why is that important? Well, it lets us really kind of see where the activity is in terms of the current volatility levels. We could say, well, 3 standard deviations, that's way out there. So maybe I want to participate on that as a sale against buying something else that's a little closer in the money, because I think that 3 standard deviation move, given that the current volatility levels and where the market is right now in the Treasury, I don't believe it's going to go up there. So again, the idea, I said it earlier, we're trying to give you put a face on volatility, so you can look at this and say, well, this volatility represents this range in the underlying and these many strikes that are currently available in that standard deviation or 2 standard deviations for the expiration. Okay, so these tabs are just going to plot different pieces of information. So as you see right now, we're on intraday volume. We could also show yesterday's volume, so you could see based on this volatility where some of the activity took place. So there was quite a bit of activity, 2 standard deviations out on the upside, and then you could see this volume change. So this is going to say, just give you a day over day how the volume numbers have changed. So we saw, based on 2 days ago, yesterday's volume had a pretty significant upside, so it probably means nothing traded the day prior in these upside calls. Okay, so you have 3 volumes, and the one really that comes into play for this Vol2Vol, and this Vol2Vol is meant to mean volatility to volume. So you're seeing the volatility range to the amount of volume that's taking place in the market as well. So this was the essence of why the tool was built, but we feel like seeing this other information is also of value. So you can, again, get an idea of what's encompassed by this current volatility level. The next thing you could look at is just straight up open interest. So now you could see where the open interest lies from the standard deviation range standpoint as well. Which strikes are likely to come into play, a percentage of the time, that type of thing. So we show you the open interest plotted individually, both puts and calls. We show you the total open interest just in a stack bar. Okay, so it tightens up the chart a little bit, and then we show you the OI change. So again, giving you a little bit of an idea of, the volume occurred in these strikes as well in order for the OI to have to change. But then we also try to represent to you, well, this was, you could see in the 133 strike, the 133 half, and the 134, 135, 134 half, 135, that was a change in open interest. So people were opening positions up with those trades and those strikes in the prior day's trade. So again, you can immediately look at this and say, okay, given where my current futures level is, I know where my range is going to be based on this. I know where my futures range is going to be based on this current volatility given these days to expiration. So 5.5%, 28 days to expiration. This is where 68% of the time, which is 1 standard deviation, this is where I expect my futures to be. So then you could start to look at this chart versus what the actual range is during the day, and we give you a little indicator of what the range is here. So you're seeing that the range was inside of this 1 standard deviation today. So you start to get an idea: is vol rich or cheap? Should I be paying more for this? Is the volatility supporting going to be supported by the amount of movement we're getting in the futures, at least from on a day-to-day standpoint? Okay, so that is the Vol2Vol expected range tool. You could play around with it, and you'll see that if I change this and I go down to like a 4% volatility and then lose that exposure, my ranges are going to tighten up, right? Say they got smaller from where they were. If I reset it, you'll see these jump up again and could be a little bigger. And you could change the days to expiration, right? So I can go down to 15 here, and you're going to see again things will tighten up a little bit, right? So we got my little bit of range here as well. And you can move the future as well, okay? So I'm going to reset this and go back to where we were. And then we have some settings. Oh, and the one thing I didn't mention, and I'm sorry about that. So you also see that we have theoretical delta lines. So this also gives you an idea. So the idea behind showing you the delta lines is so you can start to see, you know, where some of the wingier puts are present within the current set of strikes. So this also gives you an idea of the probabilities of probability of the trade or occurring or in the underlying out in those strikes. So this we thought was just even more information that we can plot on top of one chart to give you a good idea of how this volatility is supported, what the probabilities are for reaching some of these strikes or touching some of these strikes, those kind of things. And you'll see in the settings we have show odd deltas checked by default and show expected range, which are these plots by default. And then you can even show even deltas. If I turn those on, it'll show where the even deltas are as well. So that is it for this tool. Play around with it. I think you'll find it pretty interesting. And if you have any questions, again, as always, you can come over to the support section and send us an email. And we hope you're enjoying these videos. We have 4 left after today. This is 25 videos. So we've made a good dent in February so far. But we want you to keep watching. So come on back and see what we have in store for the rest of the month. Until then, take care, and we will talk to you soon.